All right, ladies and gentlemen, I hope you had a wonderful weekend. It's going to be a very weird week ahead of us. I had a lot of people ask me over the weekend, will we see some sort of drama from the Donald Trump assassination attempt? And well, that's really what we're going to have to find out here in the next couple of hours as we get the futures open, and we'll even see how everything trades all day. But it was supposed to be a week about retail sales, Jerome Powell, the Fed, and even the start of earnings. But now what happened over the weekend, we will be watching pretty much tonight and leading into tomorrow. Is there some sort of volatility effect that gets created? So we got a couple of things to talk about. I have the breakdown, I have the keys, all that good stuff, everything you need for that. We will go over this question here and talk a little bit about what to expect this week. But the point is, in these next couple of days, we should get an answer to any of the immediate volatility questions. And I mean, at the very least, there's just going to be a lot to digest this week, especially as we're getting here into summer. So Chad, I have all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we're live Monday through Friday, 30 minutes before open, youtube.com/stock market. I don't know why I was going to show you that, but then this right here too. So this is the long term. Make sure you guys get involved in the long term, but then this is also the random account generator. So what we need from this watch list, you're here, right now, whatever, any way you want to put it. I need a random option trade. Keep it below $100. Post the strike price, expiration date, all that good stuff. Tomorrow morning before the stream or before the bell, we are going to pick a random play and add it to this portfolio, and we need your help. So, Chatadonia, come on, baby. Let's get a good one. But now, run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, I'm going to start here with this question just because I got it emailed and asked so many times. And it's a wild event. I mean, this does not happen. It's absolutely tragic to a degree. I know some people, I mean, the reactions are mind-blowing, to be honest, man. But the point you need to think here is I wouldn't react too crazily, but I would keep your eye out here for the bond market. And why this has any relevance, if you guys don't recall what happened June 28th, the day after the debate, as the odds of who could win the presidency changed, you saw the bond market move, and people were talking about these theories related to Donald Trump and hard landing and what would happen if he won and all of that. So if you had an assassination attempt and people are flailing around all the odds of whether or not it's Trump or not, or Trump or Biden, we are really going to see what happens here. But I would keep an eye out for the bond market. If there's going to be any political uncertainty effect, I think it's going to be showing up in the bonds. So I would definitely watch out for that. And like I'm saying here, I wouldn't really freak out too much, but over the next day or two, you will really find out your answer of whether or not this is going to be some level of event or something that affects volatility and gets volatility up there and stays there sustained, or gets a sustained rise to volatility. So hopefully you get what I'm saying there. Watch out for that. But if it doesn't, that's what pretty much leads here into the first key. I would watch out for the earnings that get started this week. If the if the Donald Trump stuff doesn't cause any volatility, the things everybody else was going to be watching this week would have been Powell on Monday, retail sales on Tuesday, and then what sort of themes do we get from the earnings from Wednesday leading into Friday. Then it'll be a burn one week, and then the one after that, you're going to start to get a lot more of these companies. So it's going to be one part, do we get political volatility? Another part, back to the data schedule that we've been following. But that's one thing I even said here. I'd watch out for data versus earnings. The last couple of weeks, you've been getting non-farm payrolls, CPI, all of these different things to react to. This week, it will be retail sales, and that will be important, but it's not as big as data as we've been getting. And if anything, the earnings should take more precedent, and then we'll see what any of those Fed speakers bring in. So watch out for that. That is key number one. Then leading into key number two, it's going to be very easy to focus on everything we got to deal with, especially especially if that political volatility does emerge and becomes a major theme. But other than that, there is going to be this event. I think it's the third plenum out of China, and it's going to be this big event in China. But the whole point is we may be able to hear about reforms. Their economy has been doing awful, but why I'm bringing this up, you've been seeing every other week, whether it's the euro or things like France and that volatility politically and just whatever's going on internationally, it's having some effect, but it does all boil back down to the dollar, and until the dollar starts to move, we're probably not going to see anything. But the point is, there are other events going on that aren't just domestic, so especially if we get over our political volatility, I would definitely keep your eye out for some of these events. And then finally, leading into the last key here, the market is borderline ignoring everything else. I don't think this is new to any of you, but we are waiting for that policy shift. And why I'm bringing this up, because whether it's politics, whether it's data, the last week was a mix of data being good, market going down, then the PPI would be bad, and then the market went up. Everybody was asking all sorts of questions. You saw the 5 leading or the 400 going up and down and having these big concentration effects. And here's the thing, regardless of anything going on, don't forget the new narrative moving forward is this idea of September cuts. The market's going to move in various ways, and we're going to see a lot of that go on. But if we are going to watch the same thing happen from last week, it's going to be this idea and narrative of September cuts and probability going higher, and then that value rotation, that long duration coming back into play where people start buying things like the Russell, buying the names that are down, and then we're going to see how much some of those bigger cap names sell off, especially with earnings. If there's going to be an excuse to solidify any sort of value rotation or anything we saw last week, it'll probably come down to how good or bad some of these companies' earnings are. So watch out for that. Keep in mind what those broader themes are going to be. There's going to be a lot to juggle this week. I'm sure in a couple of hours we'll find out what's going to dominate. But until then, we will see. But now, let us get into the plays. So, right off the bat, I have a couple of plays that I'm going to be looking at for this whole week. And, I mean, I was going back and forth a lot on a lot of things last week. And number one, I will say earnings. I do have a couple we will talk about with there. But other than that, bonds. This is one of the plays I've actually been writing out for the last couple of weeks, and I like it. And I think there's a lot of reasons to want to own the long side of bonds. ZB, that is the longer end futures. TLT, that's a longer duration bond. Right now, everybody's already buying the short duration, the 2-year, the 3-month, the bill, but especially the 2-year. That's where a lot of investors are. Remember, it's a lot safer. We've gone over this one a couple of times, but if there really is going to be something big, or we've talked about the hard landing, the long duration bonds offer a very unique opportunity, but they also have their own risks, that duration risk. But long story short, I still like this play. We have a lot of cushion from last week, and I feel like some of this political uncertainty might increase some bond volatility. So this is all I'm going to be watching. Last week, we talked about how the bonds were even lagging the market. Even if the markets hold up, I don't know how they'll take the whole Donald Trump thing, but at the very least, I think what happens with hard landing odds, politics, the odds of who's going to even win the election, I do think the long end of the bond curve will move, especially too if that September narrative does be the thing that drives us here throughout the next couple of weeks. So watch out for that. That is play number one. Then play number two, Citi. This was a bank that reported on Friday, and I really like it. I made a play on it on Friday, but I would be on the lookout for anything like this. It's not just Citi, but any of these companies that had earnings, but they are still strong. So this is what I'm going to really be looking for. I made a small cheap play on my Citi, but they dropped like 7%, I think, at one point. So did Wells Fargo. Then they came back down to like 1%. But any of these companies that you could kind of see, they've been doing good, and they kind of like, I mean, Wells Fargo, they had a bad drop there. They even have bad guidance, but as long as they hold up, these could be good names that if the other earnings turn around and the market picks up, these things will bounce back up. Or if things do really get bad, then these could be the ones that lead on the way down. But I'd watch out for that. Watch out for the Citi. We'll go over the play that we made here in a little bit. And then coming into the final plays, I guess I'll put multiple plays, but but Pfizer, that's the one we made a play on last week, and I'm still looking for that ex-dividend play. Their ex-dividend is on July 26th, so the idea is they're going to be able to move up ahead of that, but also where it's at right now. If this thing could move above 30, I think that's going to bring big momentum. Otherwise, that'll be the top of this trade, and what I'm really looking for, get a play pre-earnings, pre-ex-divvy. If it runs up enough, we could either make it free, or if I do end up buying the shares, remember, the dividend could pay for the puts, then that'll be another opportunity as well. So I'm going to be watching out for that, and they had the news of their Ozempic drug last week, so we'll see if that does anything. And then as far as earnings, there's not much this week, but we do get some of these better companies. So literally Netflix and American Express, these guys are going to be reporting. These are my two favorites so far for this week, but it's hard to really tell so far what sort of trends. Again, we did good on the FedEx and the Nikes. I think those one being more consumer related, kind of easier to tell. Netflix and American Express are consumer related as well too, but they have different factors. I think Netflix is already going to be mad expensive. I looked at some of those options already. And then AXP, I think we hit a good one post last time, but even then, that one is a pretty expensive name too. So watch out for those, though. Keep your eyes out for earnings season. Again, last week was the start of it, and now we are only going to be getting a lot more. So those are the main plays. As far as everything else, it didn't include my other ones, but I did grab a couple of plays on Friday. I grabbed a Meta 650 call, one of them at $1.50, a little bit expensive. I should have grabbed more than one so I could make it free, but I wanted Meta since that last Friday, but then it popped up $38, and well, it came right back down. So I like Meta a lot for this earnings. I think they're going to be very, very pivotal, but these are expensive. They're a little bit more than 2 standard deviations, I believe, and for $1.50, it is quite pricey. So we hit last time on an expensive Meta. We'll see if it happens again this time, but either way, big fan of that. But that one was definitely on the higher end. And then my city play, I grabbed one of the 68 calls for 11 cents. My earnings play, remember, they only like $7 or something like that, but kept it small, and they had strength. I think they just dropped a lot. I think they may have been brought down by Wells Fargo a little bit, but the way they came up, I like the strength, I like the earnings, but we'll see if this one, I don't know if I'm too confident, hence the $11. And then I close out of my ES and my NQ. They pummeled me on Thursday, got out of them on Friday with a gain. I think I got $400 on the NQ and then another $600 on the ES, and I did a last second flip at the end of the day, made another $1,000, and then I'm still in all of those ZB contracts for my bond play. That one is still up a lot, so that's all I'm holding besides a couple of the plays. Remember, we did get rid of a lot of things. I still got just all the remaining bios and my Intel shares and all that, and then the bonds, and yeah, that's about it. And then I guess I already went over the question, and now, oh yes, don't forget, we have a lesson, baby. Multinational corporations. So Jadadonia, I hope above all else you're ready for the summer markets. And honestly, man, if the summers are slow, make sure you watch some of the other videos. Be smart. There's a lot of strategies you could do here and wait until you actually get real volatility to make a lot of moves. But also, in the meantime, we've been going over economic lessons. So we have a playlist here. If you go, it's on this channel, The Trading Fraternity, and we've been reading from this book. So if you ever want to, watch something, learn something during the day, and then even during the day when we're live, it makes sense. So yeah, but now we're on multinational corporations. This is chapter 8. We gave the intro on the live stream if you guys were there on Thursday. We didn't have anything on Friday, so now let us begin. Multinational corporations in the global economy. For many people, a multinational corporation and a firm that engages heavily in international activities are one of the same thing. Yeah, MNC is more than just a firm that engages in international activities, and many firms that engage heavily in international activities are not MNCs. The standard definition of an MNC is a firm that controls and manages production establishments, plants in at least 2 countries. In other words, multinational corporations place multiple production facilities in multiple countries under the control of a single corporate structure. The preceding definition does not capture the full range of MNC activities. However, MNCs are engaged simultaneously in economic production, international trade, and cross-border investment. Consider, for example, the U.S.-based company General Electric, which is regularly ranked among the world's largest MNCs. GE controls over 250 plants located in 26 countries in North and South America, Europe, and Asia Asia. Although production in these facilities is obviously important, the ability to manage in international trade is equally critical to GE's success. Many of the goods GE produces crosses national borders, either as a finished consumer good or as a component for other finished products. Washers, dryers, and microwave ovens that GE produces in Asia and Latin America, for example, are sold in the United States and Europe. To create this global production and trade network, GE has had to make many cross-border investments each time that GE establishes a new production facility or upgrades an existing facility in a foreign country. It invests in that country. MNCs are thus also an important source of foreign capital for the countries that host their affiliates. Thus, even though GE certainly controls and manages factories in at least 2 countries, this does not describe the full range of GE's international activities. Like all MNCs, GE engages simultaneously in production, trade, and cross-border investment. MNCs are not recent inventions. They first emerged as significant and enduring components of the international economy during the late 19th century. The first wave of multinational businesses were dominated by Great Britain, the world's largest capital exporting country in that century. British firms invested in national resources and in manufacturing within the British Empire, the United States, Latin America, and Asia. In 1914, British investors controlled almost half of the world's total stock of foreign direct investment, FDI, and multinational manufacturing was taking place in a large number of industries, including chemicals, pharmaceuticals, the electrical industries, machinery, automobile, tire, and processed foods. American firms began investing abroad in the late 19th century. Singer Sewing Machines became the first American firm to create permanent manufacturing facility abroad when it built a plant in Glasgow, Scotland in 1867. By the 1920s, the United States was overtaking Britain as the world's largest source of FDI. Although MNCs are not a recent innovation, what is novel is the rate at which firms have been transforming themselves into MNCs. We could see this unprecedented growth of MNCs in 2 different sets of statistics. The first tracks the number of MNCs operating in the global economy. In 1969, just at the tail of the period of American dominance, there were only about 7,300 MNC parent firms operating in the global economy. By 1988, 18,500 firms had entered the ranks of MNCs, an impressive growth in 20 years. During the next 20 years, however, the number of MNCs operating in the global economy more than quadrupled, rising to more than 100,000 parent firms by 2010. Together, those parents control almost 900,000 foreign affiliates. Thus, in just over 50 years, the number of firms engaged in international production has increased about 11-fold. The second set of statistics that tracks the growth of FDI over the same period. FDI occurs when a firm based in one country builds a new plant or a factory or purchases an existing one in a secondary country. A national corporation thus becomes an MNC by making an FDI. As Table 8.1 illustrates, the total volume of FDI has grown dramatically since 1990. During the late 80s, cross-border FDI outflows equaled about $180 billion per year. The figure more than doubled during the 1990s and then doubled again during the first decade of the 20th century. Between 2010 and 2019, it averaged about $1.42 trillion a year. As a consequence, the world's stock of FDI, the total amount of foreign investment in operation, has grown from $693 billion in 1980 to $36.5 trillion by the end of 2019. The last 40 years have thus brought a dramatic acceleration of the number of firms that are internationalizing their activities. And then here's the FDI chart. That's all. These numbers sound insane, actually. As the number of MNCs have increased the role, and I hope you guys are getting it too. It seems pretty straightforward. It's just kind of listing how they've grown. It's kind of saying how they proliferated, but has yet to explain kind of why everything has become an MNC or why this has happened, and not every corporation is an MNC, so he is going to touch a little bit more on that. But continuing, as the number of MNCs increased, the role that they play in the global economy has likewise gained in importance. UNI estimates that MNCs currently account for about half of all global exports, roughly $10 trillion in 2019, and much of this is intra-firm trade. That is trade that takes between an MNC parent and its foreign affiliates. MNCs are also estimated to account for 1/3 of global gross domestic product, GDP, and 1/4 of total employment, more than 82 million people worldwide. Much of this activity is concentrated in a relatively small number of firms. The 100 largest MNCs account for more than 9% of the total foreign assets controlled by all MNCs, for all 16% of all MNC sales, and for 11% of all MNC employment. Together, these 100 firms account for about 4% of world GDP. MNCs thus play an important role in the contemporary global economy, a role that has grown at a rapid pace during the last 30 years. So it'll keep going, but hopefully you get that one point there. Yes, multinational corporations are very important and they have their impact on the global economy in terms of size, but like it's saying there's even a small group of multinational corporations that have a bigger effect than all. Again, 100 multinational corporations are responsible for 4% of all GDP and control about 10 to 50% of some, or 16% of sales within the group of all of them. So that says a lot as well too. Continuing, although MNCs have a global reach, most of their activities are concentrated in Europe, North America, and increasingly in East Asia. We could see the nationality of parent firms and on the global distribution of FDI flows. 91 of the 100 largest MNCs are headquartered in the United States, Western Europe, or Japan, and about 73% of all MNC parent corporations are based in advanced industrialized countries. The advanced industrialized countries historically have been the largest suppliers of FDI as well. During most of the 1980s, the United States, Western Europe, and Japan together supplied about 90% of FDI. Their shares fell to about 80% between 1990 and 09, and then 60% between 2010 and 2019. The biggest underlying change that explains that decrease in developed countries' share has been the emergence of Asian MNCs as foreign investors. The advanced industrialized countries in East Asia were also the largest recipients of the world's FDI until the late 1980s. Western Europe and the United States regularly attracting a little more than 3/4 of the world's total FDI inflows each year. That share fell to about 2/3 of total inflows during the 1990s. Yeah, that's it. The share of inflows in European North America captured has fallen to an average of 60% between 2000 and 2009, then roughly half of the total inflow over the past decade. Asia was on the opposite side of that change, and its share of total inflows rose from 18 to 31% between 1990 and 2019. Thus, whereas historically most MNC activities have involved American and Japanese firms investing in Europe, European and Japanese firms investing in the United States, and American and European firms investing in Japan, over the last 25 years, we're seeing developing Asia become an increasingly important player as a source and well as a host to MNC's activities in other regions, and have also increased during the last 30 years. Latin America and the Caribbean saw an inward FDI increase from an average of $38 billion per year during the late 1990s to $167 billion per year, from an average of $38 billion per year during the 1990s to $167 billion per year in the current decade. These investments are heavily concentrated in a small number of economies in the region. Over the last decade, Brazil alone attracted about 40% of all investment in the region. Mexico attracted another 20% of the total inward investment. Africa also experienced a dramatic increase in FDI. Indeed, average annual inflows to Africa increased sharply, raising from $6.6 billion per year to $67 billion per year in 1990 to between $45 and $55 billion per year over the last 2 decades. During the last decade, Nigeria has received the largest share of investment flows, capturing 10% of total inflows over the period. Most of these investments have been directed in Nigeria's oil industry. Egypt, Ethiopia, and Ghana also attracted a significant share of inward investment. Inward investment increased in the economies also. Here, the inflows are heavily concentrated in Russia, 50%, and Kazakhstan, 15% in total. Thus, MNC investment in Latin America and the transition economies has increased substantially during the last 30 years, but the majority of the investment has been directed to a small handful of countries, and in contrast to Asian economies, these regions have not increased their share of the world's FDI. Feel like they just list in how much money is going into it to hide you from how important the MNCs are. But no, it feels like this is like the part in the Bible where they just start listing off the genealogies. But the whole point is it's explaining how much this concept of foreign direct investment has grown. Literally, what is foreign direct investment? That is these corporations buying plants and in making investments in these other countries to grow their trade there. So the whole practice in this globalization and the MNCs, and remember, these are the corporations that benefit off of it. You're kind of getting an idea of how rapidly it's grown, and this should also let you know even some of the incentive. Look at all the money that's floating around there. This is why people would want to go about that. But continuing, the last 40 years have also seen some emerging market countries become home bases for MNC parent firms. To date, however, the development has been limited to a small number of countries such as Hong Kong, China, South Korea, Singapore, Taiwan, Venezuela, Mexico, and Brazil. 77 of the top 100 MNCs from developing countries are based in Southeast and East Asia, with 36 of China and the other 10 in Hong Kong. Another 13 are based in South Korea. Most of the developing world MNCs are considerably smaller than the MNCs based in the advanced industrialized world. Only 11 developing country MNCs are ranked among the world's largest 100 MNCs in 2020, and as a group, the 100 largest MNCs from developing countries control a combined $8.7 trillion of foreign assets, only one half the value of the foreign assets controlled by the world's 100 largest MNCs. Even though MNCs based in developing countries remain small relative to the firms based in the US and EU, the emergence of these MNCs nonetheless constitute a significant change in the global economy. It indicates that for the first time in history, some emerging economies are shifting from a position in which they are only the host to foreign MNCs to a position in which they are both host to foreign firms and home to domestic MNCs. The rapid growth of MNCs during the last 30 years has pushed these firms into the center of debate about globalization. Indeed, practically every aspect of globalization has been linked to activities of MNCs. Ross Perot, for example, claimed during his unsuccessful bid for presidency in 1992 that the North American Free Trade Agreement, NAFTA, would produce a giant sucking sound as American MNCs shifted jobs from the United States to their affiliates located in Mexico. Other critics of globalization claim that MNC affiliates based in developing countries are sweatshops engaged in systematic exploitation of workers in those countries. Still, others argue that the ability of MNCs to move production wherever they want is gradually eroding a broad range of government regulations designed to protect workers, consumers, and the environment. We will examine these arguments in greater detail in Chapter 16. For our purposes here, it is sufficient to note that the criticism of MNC activities has emerged from the growing sense that the last 30 years have seen a fundamental change in the nature of corporate behavior within the global economy. Falling trade barriers and improvements in communications technology have made it substantially easier for firms to internationalize their activities. Firms have responded to these changes by internationalizing at historically unprecedented rates. So, you got to learn about how they have grown. That is the simple part. Like I said, I feel like there's a lot more exciting stuff, and it did say it'll lead into there on some of the earlier chapters, but for now, you got to understand how much they've grown, and little by little, and there was even some criticisms at the end, but understand why people started engaging in this activity of internationalizing or increasing their globalization, and in part, it was because of all the money that was available to gain, all of the rent-seeking. But Chatadonia, I hope you enjoyed it. I hope you're ready, but now, that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember you're blessed, baby. You are blessed. Smile. Get that smile on your face and realize all the blessings you have and make the most of it. And who you are destined to become is always more important than anything. So, Chad, I love you. Drink that water. Stay hydrated, healthy. I'll see you in the morning and horn.